Hey, you've probably seen those videos where someone says, buy these cheap stocks right now, but they never tell you what cheap actually means. So we spoke to top investors to get the real rules, the ones they actually use to find bargains in the market. And they gave us an exclusive list of stock picks. Want to know what they are? Just hit the subscribe button, sit back, relax, and enjoy this week's Ticker Take.
It's Ticker Take, you know.
Hey, Caroline.
Hey, John. So our theme this week is cheap, which is great because it's a subject that you know so much about.
But you know what? You're actually not wrong. I love a good deal. Like my cheap sunglasses, which I get great value out of, and I don't really care if they break.
Of course, in the market, if you buy a cheap stock and it breaks, you're not going to be a happy camper.
Very true.
So we spoke to some investors and they gave us their rules to consider when buying cheap stocks. And they also gave us some example stock picks.
And we're going to get to those stock picks coming up, but let's start with the rules because they help to create a framework for how you go about investing in cheap stocks. Rule number 1, make sure the company generates a good amount of profit. Now, this one comes from Thom of Moat Financial, who notes that when he's doing analysis on companies and their valuations, he'll typically start with price to earnings ratios, the PE ratio, which looks at the valuation versus the profit. But Chris also asks, what happens if profit starts to slide? Here's Chris.
Sometimes companies have a really low PE, but that E portion is about to decline rapidly over the next few years. So, the PE is not the be all and end all for valuations, but it's definitely where we start.
So basically, Chris is saying, make sure the company has a lot of profit in the tank to support that PE ratio.
Yeah. Meanwhile, our next rule comes from longtime investor Lorne Steinberg, who says companies have to be smart with the cash the business generates. Here's Lorne.
And a great company that generates free cash flow, part of the job is taking that free cash flow and allocating those funds properly. So buying back shares, increasing dividends, making acquisitions. And the great businesses that have been able to do that over time have created value for shareholders, and they just keep on growing one way or another.
Okay, and Lauren's comments set us up for our next rule, which comes from Patrick Horan of Agilith Capital. And Patrick notes that if a company has been smart with its money, but it hasn't been rewarded by investors in the stock market, it could be that they just haven't had growth to write home about. So as an investor, he says, with financially sound companies, you have to be very mindful of the possibility of a return of growth, a growth comeback. Here's Patrick.
We get our best value ideas using traditional value tools such as price earnings multiple, enterprise value to EBITDA, and price to free cash flow in combination with watching companies that have underperformed, typically up to a period of 5 to 10 years, where management teams have harvested a lot of free cash flow and have made the machine very efficient, but have not yet recognized growth. It is through this process, in combination with a catalyst, where we find the surprise of outperformance starts to develop.
Okay, so if Patrick's view is that a return to growth can unlock value in the stock, then what are some of the key growth metrics? Our next rule comes from investor Bob McWhirter, who says it's okay to be greedy.
Yeah, that it's okay to want to pay less for a stock and expect reasonable growth from a company. So Bob looks at the traditional, is it cheap metrics like price to earnings multiples, but he's also looking to see if that company can perform and grow at a pace that is greater than the average stock out there. So here are some of the growth metrics that Bob watches.
So the general description is, what are you paying? And what are you getting? So the measure of cheap is to look at price earnings multiples. The next question is, what are you getting, which is growth? And you're typically looking for sales growth per share. Emphasis on all the metrics we're going to be using is per share. Then after that, it moves on to business operating leverage, which if your sales go up by 10%, you're hoping that your cash flow, free cash flow, or EBITDA are going to go up by, as a guess, 20%. And then the final measure is a measure of capital efficiency, which is all the return on series, the return on equity, return on capital, and free cash flow yield.
And Bob will share a few stocks later that look cheap to him, but are growing more than the average company.
Yeah, and a little teaser here, they have a gold theme. Now, staying with that concept of getting more, sometimes you can accomplish that by thinking smaller, specifically smaller market cap companies. Why? Well, here's some great perspective from Grant White of IA Private Wealth.
So when people talk about a cheap stock, they usually mean a low price or a recent drop. But that's not what real value investing is actually about. True value comes from finding strong businesses that are trading, well below what they're actually worth. Not because they're broken, but because the market hasn't fully recognized their potential yet. So research shows that companies with, value traits, high profitability, and smaller size actually tend to outperform. Why is that? Well, because smaller companies are often overlooked, and they don't need to do the impossible to grow. I mean, take Apple, for example. For it to double in value today, it would need to create nearly $3 trillion in new market cap. I mean, that's a heavy lift, but a well-run smaller business, it might only need to grow by a few hundred million to double, which is very doable if the fundamentals are strong.
And Grant will share an investment idea based around that framework a little bit later in this video.
Okay, and finally, we should also note that every business is different, and there's a really valuable rule around that.
Yeah, this comes from Alissa Corcoran of Kopernik Global Investors, who suggests that every industry needs its own yardstick to determine what is cheap. Have a listen.
We don't believe that it's right to just look at the lowest decile of price to book, the lowest decile of price to earnings. Each industry should be measured on a different metric. For example, a shipping company that's very asset heavy, price to book makes sense. A healthcare company, maybe price to earnings, EV to sales makes sense. I think where we're most differentiated is how we value resource companies. And there we think, what makes a resource company valuable are the pounds that they have, or the ounces that they have, the tons they have. And so we are looking at the EV to ounce, or EV to pound, EV to barrel. And when they're cheap on that metric, that's when we're going to explore further.
All right, so some great perspectives there on whether cheap stocks are the right fit for your portfolio. As for some cheap stock ideas, our guests came to the table with plenty of ideas. Should we get to those now?
Yeah, we'll get to those right now, but before we do, please hit that subscribe button.
Absolutely, we could really use your support, so just hit subscribe. Okay, here we go. But first, a friendly reminder, this is not financial advice.
Stock number 1, General Motors.
Yeah, General Motors is recommended by a little less than half the analysts who cover the company. This pick comes from Thom of Moat Financial. Remember, we heard from Chris earlier, and he said if you're going to invest in value stocks, make sure the company has a deep pool of profits. Well, that factors into his GM analysis. Here's Chris.
Obviously, they are right in the middle of tariff talk and right in the crosshairs for a lot of what Trump is discussing. But it's trading around $45, and the last couple of years it made between $10 and $11 per share per year. We think that they will probably have to make some adjustments to their production, move some production from Mexico to the US. They've already made some changes with some of the Canadian plants, but over the course of time, we think that this business, like many others, will be able to adjust and persevere through any adversity like this. And so even if the earnings piece of that declines by, say, 50%, well, it's still a cheap stock. So, they're steadily buying back their stock, 5 to 8% of the shares every year. And we like companies that are returning that cash to shareholders, and GM is one of them.
Stock number 2, Allstate.
Allstate is a well-liked stock on Wall Street. This pick comes from Lorne Steinberg of Lorne Steinberg Wealth Management. Remember earlier in the video, Lorne talked about the need for companies to use their cash flow wisely. Here's more from Lorne.
How has Allstate created value for the last 20 years? They've created value by taking their capital and buying back so much stock of their own shares over the last 20 years that they have reduced their share count by almost 70% over the last 20 years, which means I, as a shareholder, have tripled my holding in Allstate. Over this period of time, Allstate's earnings and dividends have gone up, and I ended up with a stock that I've never sold for 20 years, yet it remains compellingly cheap. And here's an example, John. Allstate is throwing off about $2 to $3 billion of free cash flow every year that they can buy back stock with. Allstate's market cap is about $45 billion. As I tell people, if the stock never goes up for the next 15 years or so, if we're sitting here again having this discussion 15 years, I will be the last remaining shareholder of Allstate.
Stock number 3, Royal Bank of Canada.
RBC is also a well-liked stock on the street. This is a second pick from Lorne Steinberg. Here's Lorne on RBC.
In Canada, this boring oligopoly we have of Canadian banks. Royal Bank, including dividends, has outperformed the total return of the S&P 500 for the last 30 years. It remains compellingly cheap at less than 15 times earnings with close to a 4% dividend yield. And their earnings keep on going up. Their dividend keeps on going up. They buy back shares. Canada's a growth country. I don't have to look very far sometimes to find stocks with tons of upside, minimal downside over time, and great growth prospects.
Stock number 4, Magellan Aerospace.
Magellan is generally a well-liked stock amongst analysts who cover it. This pick comes from Patrick Horan of Agilith Capital. Remember earlier in the video when Patrick talked about disciplined companies that haven't gotten a lot of attention from investors but are then poised to shine? Well, in a lot of ways, that's Magellan in his view. Have a listen.
It's a high-quality Canadian aerospace company that sells into Boeing, Airbus, and other defense contractors. Over COVID, it had some difficulties with manufacturing, it had supply chain issues, and a troubled customer. This caused earnings to go down to about half of where normalized earnings should be. Their stock price fell about 75%. Over the next 3 years post-COVID, we've been buying the stock. The stock is just starting to perform now as margins are starting to normalize, and we think the company is in an excellent position to outperform the rest of the market.
Stocks number 5, 6, and 7, Dundee Precious Metals, Endeavour Mining, and Oceana Gold.
Yeah, all of these stocks are generally well-liked on the analyst side, and these picks come from Bob McWhirter, who we heard from earlier in this video as well. Bob talked about not just looking for the value in the multiple itself, but potentially seeing growth that could outpace some of the other companies that are out there. Here's more from Bob.
So the three of these in combination, when you look at the kind of price earnings multiple, is around 11 times. That's cheap compared to the market at 16 times. And when you look at their year-over-year sales growth, it's about 10 times more than the market at on average 68% year-over-year versus the market at 7%. So again, cheaper than the market, growing faster than the market. And when you look at their year-over-year EBITDA growth, it is approximately 10 times that of the market at 128% average. And when you look at their year-over-year free cash flow growth, it is effectively 10 times faster than the market as well. When you look at their efficiencies as far as return on equity, the return on equity is significantly above that of the market, about 50% higher at 13%. The return on invested capital is also significantly better than the market.
Stock number 8, National Beverage Corp.
Ticker symbol Fizz. This one comes from Grant White of Endeavour Wealth Management with IA Private Wealth. This is a drink maker behind brands like La Croix, which I always call La Croix. Now, when it comes to the analyst community, there's not a lot of attention on this one on Wall Street, but that's kind of Grant's point here. Remember he talked earlier about the potential upside from smaller cap names? Well, have a listen to what Grant had to say.
It might not be a household name in the investing world, but fundamentally it's rock solid. I mean, strong free cash flow, consistent profitability, and very little debt. These are exactly the types of businesses that we like, which are quietly compounding in the background while the market focuses in on, flashier names. Now, here's the kicker. At its current size, it's far easier for Fizz to double or even go up by 4 or 5 times than it is for a giant like Apple. I mean, for Apple to double, it needs to create nearly $3 trillion in new market cap. I mean, that's just an incredible lift. But for Fizz, it could go 4x with a fraction of that, simply by continuing to execute and grow its market share. And that's what we look for, the next big companies, not the ones that already have made it. Fizz gives us the combination of strong fundamentals and real upside potential that the broader market tends to overlook. That's what real value looks like.
And stock number 9, Seabridge Gold.
Yeah, Seabridge has a large gold and copper deposit in Canada. It's not covered by a large group of analysts, but the analysts who do cover it generally like it. And it's also the pick of Alissa Corcoran of Kopernik Global Investors. Here's her take.
It's fully permitted. The management team has grown ounces per share nearly every year, which is very rare for gold mining companies. Why we're attracted to this is that while gold is now loved by the market today, gold underground still trades at a huge discount relative to gold. And gold that is not producing trades at an even further discount. Just to put some numbers to this, Barrick Gold, which is one of the largest gold companies in the world, has twice the reserves as Seabridge, but 25 times larger the market cap. So there's a huge difference between what the market is willing to pay for a producer versus one that just owns the deposit. If you're using ounces per share as your valuation metric, you get to a much larger valuation for Seabridge than the market does.
All right, that is our list of rules to consider if you're looking at investing in cheap stocks, and some ideas from the pros. If you'd like to learn more about any of our guests today, we put more information about them in our description.
Yeah, and let us know in the comments if there are any cheap stocks that you like. And also, please let us know about any investment themes that you'd like us to cover in future videos.
Absolutely. Speaking of which, make sure that you hit the subscribe button right now so you don't miss our next investing video. See you next time. Oh, sorry. I'm sorry.
Why do you go yardstick?
I couldn't remember what to say. Yardstick? All right. We'll see you next time. Want to do it that way? I wear cheap sunglasses. See you next time.
Dude, funny. That worked.
Yep.